Hi everyone, welcome back to the chapter 2. Now we're going to talk about learning object 3, which is help us to understand after we're understanding the impact of external transactions, and we wanted to understand whether that transaction is going to impact on the debit side or credit side of account balance. Do not worry about what is a really debit mean or credit means. Just remember that debit means the left hand side of the account and credit means right hand side of the account. Okay, so debit and credit effects on account in the basic accounting equation is as following. So we know the basic accounting equation is asset equals liability plus stockholder equity, right? And then each asset, there's so many different accounts about asset accounts receivable, inventory, and cash, right? And the liability we kind of talk about in that example. We have a current liability, notes payable or accounts payable, and stock equity account. We talk about common stocks, return earnings, right? So every account has a left-hand side, we call it the debit side, and the credit side, we call it right-hand side. Right-hand side, we call it credit. And what is the impact, okay, of each transaction towards the account? We wanted to express in terms of increasing or decreasing. At the same time, we want to use the language of accounting, which is debit side or credit side. Since there is a relationship between these three components in terms of accounting equation, when there is increasing in asset account, we're using debit to express the increase. And when there is an increase on the liability accounts, we wanted to use credit to record that increase. When there is an increasing on stockholder equity, we use the credit side to record that increase. On the other, okay, so when there's a decrease in the asset account, we will use a credit to record a decrease. And then because asset and liability is the opposite, so when there's a decrease in liability, we use debit side, right? Debit side to record it. So left-hand side, asset increase, we use debit, right? The green arrow means increase. So we use debit side to record asset increases. And on the opposite, on the right-hand side, right, liability and stockholder equity increases with credit. So when there's increase in the green, but there are liability and equity account, we increase using credits, right? Okay. Okay, the opposite is true to decrease the balance of any discounts, right? So if we're using debit to record increasing the asset, then we will use a credit to record decreasing in assets. If we record increase of liability by using credit side, then we will use debit to record decrease in liability. We will also use debit to record a decrease. Okay, so when we look at the accounting equation, this is the basic accounting equation, right? So, but we also we talked about earlier that the stockholder equity account can be expanded to common stocks and retained earnings, right? Because this account can be split into two accounts, we know that the recording rules of stockholder equity account is consistent with common stocks and retained earning. In other words, when there's an increase in common stocks, we credit that account. And when there's an increase in retained earning, we credit that account. And further is that when the retained earning can be broken down into three more components, right? Revenue, expense, and dividends, right? We talk about that return earning is equals revenue minus expense minus dividends. So in here, return earning and revenue is consistent with each other because revenue is same side. Revenue increases return earning. Hence, when there's an increase in revenue, we want to credit it. See, this arrow and this arrow are both on the right hand side of this account. However, expense decrease return earning, decrease the net income. Therefore, when expense is increasing, we want to debit it. So this is opposite from revenue. Because expense reduce revenue, the expense is gonna be opposite from return earning. Hence, when expense increases, we want to debit. When expense decreases, we want to credit. Dividend also decrease revenue, decrease return earning. Hence, that when there is an increase in dividend, it's opposite side of return earning. Hence, we debit the increase and credit the decrease. So if you have like a little bit hard time to kind of grasp this, don't worry. We're gonna talk about in the objective 4 and 5, and then you will gradually pick it up. Okay. Yes. So this is the equation governing the three components and the relationship between return earning. So in order for you to kind of remember how is the increase and decrease in debit or credits, we have an interesting memory aid. We call it dealer, right? Dealer. So D-E-A-L-O-R. So first three of these letters is on the left hand side, which is debit side. And the third and six letters is on the right hand side. So in another word is that DEA is gonna debit when it's increasing. Okay, LOR is gonna use credit side when it's increasing. DEA stands for dividend, expense, and asset. When you have an increase in dividend, increase in expense, and increase in asset, you remember to debit it. Okay. When you have increase in liability, owner's equity, and revenue, you remember to credit it when it's increasing. So if you remember when it's how to record it when it's increasing, then you will exactly knows how to record it when it's decreasing. Okay, so the concept check. What does the word debit mean? Okay, we talked about it at the beginning. It means on the left hand side, right? Okay. The word debit means that left hand side means left side, and the word credit means on the right side, right? And the effect of debits and credits on account balances are different depending on the type of account, right? You cannot say, oh, debit always record increasing, or credit always record decreasing, because that's only towards the asset account or dividend account or expense account. You cannot always say, oh, credit is always record increasing and debit always record decreasing. That's halfly true, but halfly not true, because in that scenario, those account has to be liability account, owner's equity account, and revenue account, right? So sometimes debit increase account balances, sometimes it decrease accounts. When debit increase accounts, it should be the DEA accounts, right? Dividends, expenses, and assets. And when debit decrease accounts balance, it's gonna be what? LOR accounts, right? Liability, owner's equity, and revenues. Okay. So now we're just gonna learn how to record transactions in a journal using the debits and credits. Okay. So we will talk about what is journal. Journal is a fabric of accounting language. It's almost equivalent to the sentence of English. So journal is used to recording the business transactions. It's like you record a journal today, meaning that you're taking your personal journal. You say, okay, August 14th, August 15th, this happened, that happens. Exactly the same essence. accounting journals is also have a date, and also it must have a debit side and a credit side. Okay, and it's like twins. When you have a debit side, you must have a credit side. And this journal, at least one account is gonna be debited, and another account has to be credited. Like we said, 3 steps, 3 questions, right? Which account being affected? Is it increasing or decreasing? Which another account is impacted by the transaction? Is it decreasing or increasing? So now on learning object 3, we want to say, okay, instead of you telling me it's increasing or decreasing, are we going to debit it or are we going to credit it? And how we decide whether we debit or credit it is depending on the DEA LOR rule, right? So DEA, it means with DEA account means dividend, expenses, asset account. We want the debit when it's increasing, right? Because in the journal, we will not say increase here or decrease here. It doesn't work that because every time increasing or decreasing, it could be opposite from each other, because one asset account is debit side and the liability account is the credit side. So right hand side. So right hand side, when you're increasing, you would not be differentiating if you just say increasing on the title here. So you have to use debit and credit to record this transaction. Hence, every journal has to have a debit side and a credit side. At least one or two accounts, at least 2 accounts involved in one journal entry. Okay, and you want to put the description of this transaction saying I borrow money from a bank for $2,000. Right? So that's the format of a journal entry. Okay, prior to the widespread of using computers and companies record their transaction in a paper-based journal, which look like this is the term of journal entry. By doing journal entries, it's gonna help us to digest or understand the business essence of the transaction much more clear. Regardless whether we can simplify this process, all the cutting edge state of art computer systems can record the journal entry for us. But the beginning, for every accounting major, then you need to know how to write this journal, because without a journal you would not understand the balance of each account, right? So when you are using you are investors and you are reading those balances, you don't understand how did we get there. Okay, so let's look at this example, recording a transaction. This is the first example that we want to show you how to record it. First, on December 1st, Eagle Soccer Academy sells a share of common stocks to the investor for cash of $25,000. So what are we gonna do? We understand that this transaction impact 2 accounts. One is cash account because we receive cash from investors. Second is a common stock account because we start to have common stockholders, right? Hence, the cash account, because we receive a cash, it's gonna be increasing cash, okay? And because we have a common stockholders now, so you're gonna increase in common stockholder account for $25,000. So when we increase in cash, remember DEA, we debit increase, right? When we increase in common stock, it's gonna be LOR. It's gonna be the common stock is owner's equity. We will credit the increase. Hence, you will see, right? So when we have a cash increase, we debit. And when we have common stock, which is SE, which is owner's equity, SE stands owner's equity, we credit it. Okay, just that simple. Okay, so common mistakes. So is that, okay, I wanted to point out that, remember, every time you put a debit, this debit side of the account, it has to be all the way to the left, okay, all the way to the left, and then also the amount is all the way closer to the left. And then when you credit account, the second line of the account, it has to be a little bit indent between these two, and then the amount has to indent from each other. Okay, so students forget to indent sometimes in the credit account name. for the account credited to be sure that indent both account name and amount. Okay, so to summarize this video that we just look at the debit and credit, first of all, do not panic or feel that you are overwhelmed, because I myself took a very long time to understand the debit and credit. But trust me, once you get it, you will do like fast like that. So for this chapter, our goal is to introduce you. There's a debit and credit concept, and then you need to remember the simplified remembering rule. DEA means, on the left hand side, means debit accounts, right? And LOR means credit balance accounts. Hence, when it's increasing in debit accounts, we debit. When there's increasing in credit accounts, we credit. Okay, this is this learning object you want to take away with. And also, I want to give you a short kind of analogy between English language and accounting language. So the very day of debit is born is when it has a twin credit. So this is a sentence quotation from a very famous accounting educator. Okay, so just think about debit and credits always stick together. Okay, there's a debit, there is a credit, and those two has to be balanced. And a journal entry is actually a sentence form of English language. It's like when we're writing English paragraphs or papers, we're starting with words and then we put them together in terms of sentence, right? And journal entry is the sentence analogy to the English language. So we learned the accounts, which is the verbs and stuff, but we want to put them into a story. The story is using journal entries to record that transaction, and hence the journal entry is a sentence of a form of accounting language. And the English sentence require at least one noun and one verb, right? And there is a non-verb agreement as well. So if you say I, you have to put am. If you say you, it has to be are. So if you she, it has to be is, right? If they, it has to be are. So there's a apples has to use are. One apple has to be use is. It's the same kind of combination. So accounting sentence require at least one debit and credit, just like English sentence needs one noun and one verb. And the debits and the credit must equal. Okay, in every journal entry, debit side and credit side has to equals to each other. Okay. An English sentence requires proper format by capitalizing the first letter of the first word and adding the punctuation mark in the end, right? Because when we write the first sentence, we have to capitalize the first word. Similarly, in accounting sentence require proper format as well by placing debit always on the left hand side, right, the top and the left hand side, and credit always at the bottom and the right hand side. Okay. So I hope this little explanation can help you to find kind of commonality between English language and accounting language. And do not worry if there's a learning curve, and I'm here with you. Okay, so I will see you in the next video. Thank you very much.